Welcome back, everyone. This week we're going to be talking about SurgePay, ticker symbol SURG, and I will be going through my Substack publication. The link will be in the description below, as I would recommend you check it out as a consequence of me having a lot of internally linked websites that you might want to visit to more thoroughly examine the things I say in reference. So, with that out of the way, let's get into this. I'm going to cover what is SurgePay, and then we're going to go over some definitions, and then we're going to give a overview, then we're going to get into the bull thesis, and then the bear thesis. So I expect many of you not to understand the terminology or this specific industry, and as a consequence, you might get a little bored at the beginning of the video going through definitions. If that's the case, fast forward, and if you're still interested in the meat of the article, then you can come back and watch the beginning of the video, even though that messes up the algorithm for me, but it is what it is. With that out of the way, let's get into this. What is SurgePay? They're a B2B fintech utilizing POS software to optimize their TAM. That's business to business fintech, financial technology, using point-of-sale software to optimize their total addressable market. Their primary targeted demographic is the underserved and underbanked community. Or they're a telecom company. They're providing the internet to poor people for free, and the government is paying them to do that. It's a recurring revenue subscriber model. They're an MVNO who's using the APC to acquire poor people's business. Don't worry, we'll get into those terms in a moment. Today's piece is going to be focused solely on their mobile broadband service segment, as it's the one with a catalyst which has already been demonstrated by rapid growth and is the make it or break it factor for earnings. To me, this is first and foremost an ACP play. Defining words and ideas. It's important to cover some basic terms if you're unfamiliar with the industry-specific jargon. If you have a traditional understanding of words, then you might come to the wrong conclusions of what others are talking about within a specialized field. An example of this is deposition or belt. To geologists, these are accumulations of mineral deposits, depositions, within a geographic region that's distinct from other regions. Belt. So, some definitions. Mobile broadband. Mobile broadband is the marketing term for wireless internet access delivered through cellular towers to computers and other digital devices using portable modems. Although broadband has a technical meaning, wireless carrier marketing uses the phrase mobile broadband as a synonym for mobile internet access. Some mobile services allow more than one device to be connected to the internet using a single cellular connection using a process called tethering. ACP, the crux of today's piece. The Affordability Connectivity Program, ACP, is the successor of the Emergency Broadband Benefit, EBB. These are government subsidies. Interestingly enough, the target demographic seems to be those who speak English, Spanish, Filipino, and Vietnamese. I say that because those are the language options provided on the site. The genesis of all of this took place due to the COVID-related policies that government officials took. This is actually an important detail. Part of the bear case against SurgePay is that this relief will come to an end, which makes enough sense. Once COVID is over, then the additional assistance should be over, right? According to the FCC, the EBB program will conclude when the fund is expended or 6 months after the end of the public health emergency. They essentially made a bunch of people poorer and are now giving them subsidies to help with their poorness. Of course, it also helps those who were poor to start out with. The reasoning for the EBB and now ACP is to help people afford the internet, which is more and more a necessity than ever. The ACP was funded with $14.2 billion. Once those dollars run out, then ACP is done, but not if they keep funding it. It's expected to run out in 2024, but with roughly 20 million people using it and 2024 being an election year, I find it difficult to believe that they'll defund it. I also struggle to believe that the government stopped subsidizing as opposed to increasing their subsidies. After all, the EBB was $3.2 billion that then became $14.2 billion when it was subsumed by the ACP. That's what governments do. They increase deficits, not decrease deficits. Why? It's easier to buy votes when you give away free stuff. Next term, MVNO. That stands for Mobile Virtual Network Operator. Is a telecommunications company that provides wireless communication services to customers without owning the underlying network infrastructure. I wouldn't consider this an underserved market. Just look at the competition. That link will take you to a Wikipedia page that shows you a bunch of MVNO market participants. Interestingly enough, SurgePay Phone and Torch Wireless aren't even on the list. We're going to skip this section because it's long, and if I haven't lost your attention already, I'm getting ready to, more likely than not. So we'll come to that at the end because that presupposes that you're actually interested in anything. So let's get into this. A convoluted story. Looking at their 10Q. Everything is stagnant or taking a dive except the SurgePay Phone and Torch Wireless. Interestingly enough, there isn't much of a mention of this phenomenon on the conference call. I also don't care too much. Why? Because this is a government subsidy play on their SurgePay Phone and Torch Wireless. Plain and simple. You must understand that the crux of this trade is predicated on the continual existence of the government program, the ACP. Of course, you could say that the deterioration of the rest of their business is writing on the wall of something more material and systemically wrong. And fair enough. If we look at their press release, we see that the following is their game plan for 2023. Business outlook. For the full year 2023, the company expects to achieve the following targets. Total revenues of at least $190 million, positive operating cash flow in 2023, 13,000 stores transacting on the SurgePay's network, and over 500,000 wireless subscribers. It's to be assumed that the following math is with SURG, as I'll probably call it for the most part from here on, which is the ticker symbol, at roughly a $66 million market cap. The purpose of the following is to get a feel for what multiples the stock is trading at. This also assumes that their business doesn't ramp up in the second half like Mr. Cox, Brian Cox is his name, has implied that it will. That's the CEO. This is all to say that we're being conservative with our estimates. Q1 revenue was $34,776,443. Q2 was $35,886,433, which is to say that the first half of revenue was $70,662,000. I don't want to bore you all with every last digit, so I'm going to kind of improv here and not go 9 digits deep every time I say something. If you annualize that, it would be $141.3 million, which is roughly $50 million shy of their goal. This implies that SurgePay is trading at pretty much half of revenue. I will note that their gross profit margin is expanding though. In Q1, their gross profit margin was roughly 22%. In Q2, their gross profit margin was roughly 28%. Now to the next line item, cash flow. Q1 cash flow was $2.8 million. Q2 cash flow was $224,000, meaning that the first half of the year saw about $3 million of cash flow. Annualized, that equals $6.17 million. This implies that SurgePay is currently trading at 10.7 times cash flow. In Q4 of 2022, we saw cash flow increase because there weren't expensing customer acquisitions as much. The reason is that they were trying to get better pricing on their tablets and therefore had to temporarily curtail the customer expansion. This also implies that more of the revenue manages to work its way through to net income. Quick disclaimer here. Essentially what happens is the ACP program is willing to give $30 a month for broadband connectivity to individual citizens. And they're willing to give you a one-time per household reimbursement of $100 per household. So what happens is SurgePay comes through, buys the tablets for cheap, and then call it $65, and then the government gives them $100. So they make $35. Of course, that's ignoring SG&A and all kinds of other operating expenses and so on, but the gross profit is $35. Then SurgePay is also an MVNO, so they go out to the MNOs, which is to say that they're a cell phone company, an internet company, and then they go to the big dog internet companies and buy a bunch of broadband width from them at wholesale discount. So the government pays for $30 worth of broadband a month. Surge goes out there, gets it for $15 or so, and then the government gives them $30. So they make $35 off the tablet, and then they make, call it $15 to $10 off the internet every month. So now you're caught up on that. That's the genesis of this argument, is they're going to get more and more people, thus they're going to make more $35 sales, and they're going to get that recurring revenue of monthly broadband connectivity. So, as you understand that means that SurgePay has to buy tablets to give to people. So that's an expense, and they have to do that before they get reimbursed. There's a time lag. I have to buy a tablet, give it to you, and then in a month or two, the government will give me the money for the tablet, plus some. That's the business model, as far as I'm concerned. So that means that SurgePay must pay for growth. Acquisition costs are expensed, not amortized, which hurts net income. Tablet costs are paid upfront and revenues are generated later, with a cash-on-cash return of a couple of months. $65 tablet plus $12 corner store clerk for commission, which we'll get into, and then a $15 broadband, while being reimbursed a month or two later. Surge recognizes revenue when it's rendered. Optically, this is bad for cash flow, and the inverse of this is true. So as we'll discuss in a moment, when they stopped trying so hard to acquire customers as they did back in the back half of 2022, then their cash flow will increase. However, we should see cash flow and net income do well now that they have better margins, allowing net income to improve, and their bulk purchase of tablets is out of the way, thus enabling cash flow to rebound. Let's throw net income in there. Q1 net income was $4.5 million, and Q2 net income was $6 million. That means the first half of the year saw $10.6 million of net income. Annualized, that equals $21.2 million. This implies that Surge is currently trading at 3.1 times net income. Before we get to the final line item, which is stores, let's look at EBITDA. Even if you think EBITDA means bullshit earnings, the reason being is that your shares will be diluted in the stock bonus compensation package of the CEO and CFO, which is in part predicated on EBITDA milestones. This will be covered more in the bear thesis portion of this article. Q1 EBITDA over $5 million. Q2 EBITDA was $6.4 million. That means the first half saw $11.4 million. Annualized, this equals $22.8 million. This implies that Surge is currently trading at 3 times EBITDA. Stores. On the Q1 conference call, Brian Cox said they were in roughly 8,000 stores, yet that number didn't material change come to Q2. This means that their time has become compressed to roll out 5,000 stores in order to meet their yearly goal. And finally, wireless subscribers. Q1 2023 saw 250,000 subscribers. Q2 2023 saw 275,000 subscribers. What this indicates is decelerating rate of change quarter over quarter compared to 2022. Because in 2022, Q1 numbers were 75,000 and Q2 numbers were 130,000. So 2022, between those two quarters, saw, let's just call it an 80 or 90% increase. And 2023 saw only a fraction of that in percentage terms. However, year over year, they're knocking it out of the park. At their current quarter over quarter rate, they'll only get to 325,000 subscribers, which is a far cry from 500,000 subscribers, which is their goal. It is worthwhile to note that it is still positively inflecting and is directionally hitting in the correct way. Here's the thing. They've already been communicating about the short-term and interim lackluster growth. Brian Cox in the Q1 conference call had this to say, quote, "I think the skew of customer growth and store growth will be more heavily skewed in the third quarter and fourth quarter," end quote. He reiterated that point in the Q2 conference call. Quote, "We anticipate the full benefit of these partnerships beginning to bear fruit towards the end of the third quarter, with growth accelerating quickly and continuing in the year's second half," end quote. In the Q4 conference call, he let matters be known. Quote, "We announced the closing of a senior credit facility on November 18th. This dedicated financing allows us to move away from ordering tablets on the high-cost secondary market and order direct from the manufacturer. Going direct reduces our per-device cost over 20% and allows us to utilize our financing facility more cost-efficiently. I think it's important to state that switching from real-time spot buying devices on the secondary market to purchasing, manufacturing, and the shipping logistics of buying direct from the factory overseas did force us momentarily to take our foot off the gas, no different than shifting gears in order to accelerate at a higher velocity. Let's stop here for a moment to remember something that we already discussed. SURG must pay for growth. Acquisition costs are expense, not amortized, which hurts net income. Tablet costs are paid up front and revenues are generated later, with a cash-on-cash return of a couple of months. 65 for the tablet, 12 for the clerk, and 15 for the broadband, while being reimbursed a month or two later. SURG recognizes revenue when it's rendered. In the Q1 conference call, he further elaborated and gave some prognostication. Quote, "With our funding in place, we've secured a consistent supply of tablets at a significant lower cost, and in the meantime, we've built out the infrastructure to distribute them in the most efficient means possible. We should no longer see periods of throttling growth due to running out of devices. We expect revenue to ramp up higher in the future quarters," end quote. Now all we have to do is figure out if things will actually pan out this way. In a September press release, they noted they're partnering with Clearline Mobile. Will this aid in their 13,000 store year-end target? One of the biggest challenges is keeping promotional material, "One of the biggest challenges is keeping promotional material up to date in thousands of convenience stores nationwide. We don't have product facings on the shelves, so our in-store marketing is important for driving customer awareness. Having the ability to run and control our ads in real time from a centralized server on the mounted point-of-sale tablets alleviates the need to consistently update our posters, stickers, and other advertising materials. We expect point-of-sale tablets to be a catalyst for higher revenue per store and allow us to expand our presence in stores nationwide, without the need for salesperson to consistently visit and manage stores in a territory," said Jeremy Gies, president of SurgePay's FinTech. The incentives are also aligned. The store owner is making a residual income, meaning that they have a vested interest in signing people up to the ACP. However, the hourly clerks have no incentive. thus the point-of-sale customer-facing tablet, as well as they're partnering with LeadX. LeadX Solutions proprietary software will authorize SurgePays to communicate directly with consumers when performing ATM transactions, providing the company with extended reach to a fresh channel of qualified, affordable connectivity program customers. Okay, on to the bull case. And my throat's getting tired, so I'm probably not going to revisit the top section of expanding upon further questions you might have, like why do MVNOs even exist? And why do MNOs allow MVNOs to piggyback off of their broadband and other things like that? So you can go read that. Either you can freeze the frame on the video or you can go to the article and read it. Anyway, bull case. We've covered some of the bullish reasoning in the above segment, but let's go over it here to be clear. From a technical standpoint, it closed the gap that was created after earnings. If you have a disposition for such things, such a gap fill strategy, then this creates an interesting entry point. You will notice the gap fill. Some other points of interest. Gross profit margins are improving. It's trading at roughly 3 times first half annualized net income. It's trading at roughly 3 times first half annualized EBITDA. Subscriber growth continues to positively inflect, albeit slower but directionally good. According to the Q1 conference call, quote, and again, simple math, our devices used to be $93, now they're $65 ballpark, end quote. Mr. Cox in the Q4 call knows how to hit the right notes. Quote, I think it's important to state that switching from real-time spot buying devices on the secondary market to purchasing, manufacturing, and the shipping logistics of buying direct from the factory overseas did force us momentarily to take our foot off the gas, no different than shifting gears in order to accelerate at a higher velocity. For example, we were faced with the decision of air versus ocean freight. The timing for ocean was an additional 35 days difference, but the cost savings averaged over $35,000 per stage shipment, of which there were 13 shipments. When forced to choose between optimizing the appearance of growth or maximizing the present value of current and future cash flows, we'll always choose the cash flows, end quote. If I take him at his word, which I struggle to take anyone at their word due to me being naturally skeptical and suspicious, and my baseline presupposition is that everyone is out for nefarious reasons and that they're guilty until proven evident. But with that aside, if I take him at his word, then these are the qualities to look for in a management team. SURG is reducing costs on the tablet front, but also at the storefront. Quote, so that store owner is quick. Now we're paying the store $10 to $12 as opposed to paying someone in the field $50. Some context of this is that in order to get customers, they would have people go around with pop-up tents to different communities and neighborhoods and enroll people. And that was costing SurgePay $50 per person enrolled. So now they're transitioning from that model of acquiring customers to doing it in the actual convenience stores and bodegas and paying $10 or $12 as opposed to the $50. So with that out of the way. So when you look at utilizing a borrowing base and our access to capital and really looking at it globally and staring at a year and saying, okay, what's more important here? Are we trying to put up numbers every 90 days just to make certain people out there happy, or at the end of that year, at the end of that 2 years, do we want to squeeze in? And again, simple math, our devices used to be $93, now they're $65 ballpark. Our field sales cost us $50. That was from the Q1 2023 conference call. Another cost-saving measure that SurgePay is implementing is having ACP candidates sign up via convenience stores versus in the field via pop-up tents. This is beneficial in many ways. Retention of customers is suspected to be higher as the customer knows where to go if they need help. This also minimizes attrition of customers. Why does that matter? That matters because it's hard, if you have any questions, to go back to a pop-up tent that moved on to the next town. And the reason the attrition numbers matter is that if the person stops using the service, then the government stops paying, which means that SurgePay loses income. This is important because if the person stops using the SIM card, then SurgePay stops getting paid, which means that people will be more willing to get help and thus more likely to continue using the ACP, and thus SurgePay will continue to generate revenue. Okay, so Wall Street wants year-over-year revenue growth, net income growth, and or EBITDA growth before they really get too interested in the company, albeit a $66 million market cap company. So far, SurgePay has succeeded in 4 quarters of EBITDA growth and so far have successfully executed on 3 quarters of net income growth. This means that come their Q3 report, assuming it's good news, they could turn some heads, and I'd rather be positioned before and not after the head turning. Bear case. As a side note, I worked the hardest on the bear case here. If you don't know why a stock is trading cheap, that's the same as saying you don't know what the risks are. It's often interesting in life. I set out to talk about why I own a stock and all I do is bash it. I inevitably end up leaving out crucial details as to why I'm even long the stock, such as how the company gets paid $100 for a tablet yet buys them for $65, or how they're scalping a profit from their wholesale purchase of broadband yet accepting the full $30 reimbursement. I also suspect that the consequence of me presuming that my reader already has some knowledge on the matter. After all, you didn't just stumble across SurgePay. There's a reason you looked it up to begin with and thus found this article or video. Most people are familiar with the buy case, yet they leave out the reasons to be bearish. And that's why I suspect I hit the bear case so hard. It's less discussed, yet is crucial to come to terms with. We'll cover some of the following material: shady past to the CEO, the short report, stock dilution, ACP overhang, microcap, short interest and insider ownership and potential risk of a PE buyout, the warrant overhang, and short interest is close to 20%. Short report, this is why, by the way, you want to go to the actual Substack article, because if you're looking for this short report, here it is. Here's the link as I've written down, and you need the article to hit the link to actually read the bear report. So that's why it's in the description. In my research, I came across the mention of this mysterious short report numerous times, yet no one would mention who or where it came from. Well, here's the link. SurgePay didn't meaningfully address the report as far as I'm concerned, and probably rightfully so. The more you review something, the more guilty you are type dynamic. Weirdly enough, I've seen numerous mentions attributing the short report release to the fall in the share price. Yet the stock was already down 34% from its interim high from where it ran up to from the earlier May earnings release. From July 11th, the release of the short report, to July 12th, the stock dropped 14%. With that said, I don't have much to say on the short report. Why? It's above my pay grade, and I don't have a sizable position in the stock to be concerned enough with to invest the time to iron out the details. Quite simply, it's a risk I'm willing to take. Now, some might say that's priced into the stock and that's why it's trading at a depressed multiple. All I have to say to that is that's absurd. If the SEC were to open a case against SurgePay tomorrow, I can assure you that the stock would drop substantially, which means that it's not priced in. At least not all the way, but then that begs the question is what one means by priced in, and then you realize it's on a spectrum, and maybe it's a going concern. You see that a lot with beaten down stocks. They say, well, bankruptcy's priced in. It's like, if that was the case, it would be trading at zero. So there's a probability assigned to such matters, but I won't bore you with going off on a side tangent. Another issue for this company, which frequently arises, are concerns over Mr. Cox's past. The short report covers that, so I won't get into it here. It's always worth knowing the past of the people you're investing with. I'm always in awe of all the Bitcoin evangelists who were fans of Riot, yet were clueless as to Barry Honig's past dealings. Stock dilution. From year-end December 31st, 2021 to year-end December 31st, 2022, the company saw quite the share dilution, which is to be expected when a company IPOs on a tight float to manipulate the share price higher, which is all too common of a theme. And I don't mean the word manipulate in the legal sense, but more in the ubiquitous, common everyday sense, because I've discussed that topic numerous times. Which is why shorting unlock periods can be so profitable, but I digress. In the first 6 months of 2023, they've diluted the shares further. For the 6 months ended June 30th, 2023, we're now sitting at 14.15 million shares, basic shares outstanding. That's a 13.3% dilution. But wait, there's more. According to the 10K, there should be more dilution coming our way. Page 30 is definitely worth a read. This is the CEO, but the CFO has similar structuring. It's always nice to see the CEO makes better margins than the company itself. If all milestones are attained in their compensation packages, that will add north of 13 million shares to the current shares outstanding. And I was being very conservative and generous with 13 million shares, by the way. It's more like, oh, I don't know, 13 million? So, almost doubling the float. Oh, I lost my spot. Oh, now in all fairness, the company would be doing incredibly well at that point if they were able to actually dump all those shares. After all, we're currently sitting at a $66 million market cap. I'd love to see $1 billion market cap, let alone a $5 billion market cap. It's also always interesting, as a side note here, it's always interesting to actually read benefits. Whether you're an employee that works with the company, to really see the difference between how you get compensated and how the CEO gets compensated. Like, Mr. Cox will be entitled to receive an annual car allowance of up to $15,000 per year. Or how about this one? Home office expense reimbursement of up to $5,000 per month. That means he gets $60,000 a year for home office expense reimbursement. Which I would say is probably, I don't even know. I mean, more than the salary of probably 50% of the employees that work there. And then he gets a remote housing allowance of up to $10,000 per month. And he's entitled to reimbursements of up to $10,000 a year in costs associated with income tax preparation and estate planning. Like, wouldn't it be nice if your boss paid for your H&R Block visits? You know? But, yeah, I digress there. Between the CEO and CFO, I would see them reaching their EBITDA goals and the lower range threshold for the subscribers by year end. That would toss an additional 3 million shares in the market. That's roughly a 20% dilution. But there's more. A $1 million shelf offering. I guess if it's any consolation, they can't issue more than a third of the outstanding public float if the market cap remains under $75 million, or roughly $5.30 a share. And let's not forget about those warrants, which is reflected in the diluted shares outstanding. And they're exercisable at $4.73 a share. And that doesn't expire till, I believe, it would be November 4th of 2024. On to the next point, short interest. Short interest is sitting around roughly 20% of the float. It's really more of an observation that I'm sharing here than anything else. It's worth noting that there's roughly 14.2 million basic shares outstanding, with roughly a float of 8.5 million shares. This is due in part to the large holdings that Mr. Cox has. So just remember, we have a $66 million stock with roughly 40% of the shares tied up. With SURG being a microcap with heavy insider ownership, it seems like a ripe candidate for a PE takeout. Not that I've heard any rumors or anything, but it's always on my radar. Oh, and if you don't believe me that Brian Cox owns a lot of shares, take a look at this. It's from the last 10K. Here you'll see that he owns 5.4 million shares, which is, at the time of the 10K, was 38.6% of the common stock. Then we have the ACP overhang. The ACP's $14.2 billion is expected to run out at the end of 2023 or Q1 of 2024. Until that happens, SURG is being treated as a dead man walking, and its earnings multiple reflects that. If the ACP is canceled, then SURG is essentially a business that has 3 to 6 months left of profitable revenue generation, as far as I'm concerned. Some argue that they'll still do well if the ACP were to be canceled, but I won't be bag holding, waiting around to find out if that's true, which will only be revealed in the subsequent quarters henceforth. In my eyes, SURG has been a failing tech company and shrinking telecom company in a highly competitive, lower margin MVNO market. The ACP was their saving grace, and now they're giving it a Hail Mary. After all, how can you compete with this? By the way, that's Mint Mobile if you don't know. I think the risk of the ACP being canceled is low. First off, it was a bipartisan supported piece of legislation. And even if it wasn't, 2024 is an election year. Canceling 20+ million people's internet is not how you buy votes. It would be politically risky to do anything but to continue to hand out free stimmies. After all, they're trying to buy votes. Then, anecdotal evidence. I'm always hard-pressed to find SurgePay as an ACP provider in my area. On some lists I've looked up, they don't exist, and on others, they're halfway or all the way down the list. Just type into Google ACP providers and see what pops up. This is one of the things that popped up. AT&T, Xfinity, Verizon, Cox Connect Assist, Extreme, blah, blah, blah. And then, we're almost done here. Sentiment. I don't like this kind of sentiment. This is Seeking Alpha. Strong buy, strong buy, strong buy. Everything's strong buy. This is also why I focus so heavily on the bear case. For those of you still reading, I'd also like to mention an investment bank that is covering SURG. If you click on that link, then you'll find the investment bank and you can read their publication. As always, this is not investing advice, and do your own due diligence. If you haven't found at least one thing that I said wrong in this piece or have unfairly decontextualized, then you're probably not paying attention. I've already had to update this post twice due to me observing my own errors of inconsistency. And by the way, let me add to that, while reading this, I've noticed 3, and I only remember 2 things that I wrote wrong. And not factual errors, but more spelling, grammatical issues. Double spacing, a capital letter where there shouldn't be a capital letter, and I don't remember the third thing. So, like I said, pay attention. Disclosure, I am long SURG. Yeah, I don't want to read the stuff that I skipped, so I'm not going to. If you want to read the beginning of this post, I mean, by now viewership's drastically fallen off, so if you're really that interested, click on the link in the description, go visit the site, read it for yourself. Hate to be that way, but I'm going to be that way. So with that segment, since this is the YouTube channel, and I don't really do this on my Substack for really no purposeful reason, I just don't, I'm now going to transition over to my weekly stock portfolio performance. And here we go. And this is what happened. I bought SurgePay. I bought Town Square Media, which is another telecom play. So now I have two telecom plays. And both of them are subject to change and holding at any moment. I can't say they're high conviction plays. They're Town Square probably shouldn't be 5% of my portfolio, and SurgePay is 2.2. That seems more accurate, but nonetheless is what it is. Town Square Media is a terrestrial radio company that's now trying to transition to digital marketing and digital advertising through the digital marketing segment is called interactive, and the digital advertising segment is called Ignite. And at this point, in recent time, and you need to understand recent time means months or quarters, not years and not weeks. In recent times, they've exceeded 50% of the revenue generation from interactive and Ignite segments. And since I'm on this topic, so half of the revenues are now being generated from digital. That's the catalyst. That's the inflection. That's the thematic change of company segmentation and reporting, going from terrestrial radio to digital. And revenues have dropped from the terrestrial, and they took a step back in earnings on the digital marketing interactive, which is a DSP, digital supply platform. Anybody who watches this channel consistently knows that I was looking at getting involved in the advertisement section because connected TV, CTV, and targeted ads seems somebody's going to make money on that, and I'm trying to figure out how to play it, and sadly not all things are playable, and I'm not saying that isn't, I'm just saying that I was looking into DSPs and SSPs, demand side platforms, supply side platforms, advertising, all that stuff. Anyway, I then stumbled across, rabbit holes, I go down them all the time, across Town Square Media, which is always funny because in all the research I did on digital advertising and advertising in general, Town Square Media never came up a single time, and yet here they are generating more and more of a significant portion of their revenues and their earnings from a double-digit growing digital advertising segment called Ignite, and not a mention of them, which is always funny how that works. And then you could say the same thing for, the newspaper companies, for instance, the Dallas News or New York Times or Lee Enterprises or those types of companies. And like Lee, for instance, which I thought about taking a stab at, their old-timey segment, print, has completely, I don't want to say complete, has really nosedived and fallen off a cliff. The thing I like about Town Square is that, yes, the terrestrial radio segment is, you could say, dying off, generating strong cash flows, but slowly dying off. But it's not dropping, which allows the digital segments to get up to speed while, one side's shrinking a little, the other side's growing a little bit, as opposed to a massive smash into the original old business model without being able to compensate on the digital side. For instance, I suspect that one of the things that Lee Enterprises is actually now at 42% digital sales, I believe. And this is what I'm talking about, is, sorry for this harebrained, inconsistent conversation piece, that they're trying to entice people to subscribe to online. So what might they do? They might say 6-month subscription for $1, because they want you to get hooked and recognize that's not all bad and have an acclimation period. And then since you're automatically enrolled to resubscribe after your subscription expires, then they'll roll you over into actual real money, not $1. And the problem with that is here you have newspapers collapsing in sales. And even if digital picks up the slack there, and they go from newspapers, everybody went from newspapers to digital, it's not going to be the same money, because here you are offering $1 for 6 months. So that means that it postpones the inevitable profitable move, let's just assume that's what it will be, to digital. So that's why I like the Town Square play, because they're chipping away at terrestrial radio while slowly implementing digital. And it makes for a much smoother transition. So that's the tangent on all of that. I added to my triple flag precious metals position, which is royalties and streaming company. Then, it seems like I thought I might have done something else. So, Town Square, SurgePay, triple flag. Maybe that's it. I thought about, interestingly enough, and this is how my mind thinks, with the current, how should I say it, developments with Israel and Palestine, there are some Israeli listed companies. One of those companies is Upstart, because not Upstart, I'm sorry, Pagaya. As I was talking about with Affirm, that's why I think last week's video was Affirm versus Tidewater, or Tidewater versus Affirm was the title. I've been looking at the fintech space, and besides atrocious earnings and profits and cash flows and stock-based compensation and shareholder dilution, which are some of the things I discussed in this piece, the earnings multiple on the seemingly good ones that are actually generating free cash flow and such is just so high. I don't feel like I have any margin of safety. So here I am looking at advertising. Here I am looking at fintech. And interestingly enough, I pick a telecom company to express both views as they're transitioning from an old business model to a new business model. In some sense, more so for Town Square than SurgePay. So it's just always kind of funny how those things happen. I must say 2 weeks ago, or a month ago, I did not see these things happening. But here we are. So, yes, back to Pagaya. So, event-driven catalyst plays that can create opportunities, whether on the long side or the short side. I'm not really shorting, so long only so far. And, well, that's not true. I've done inverse ETFs. Anyway, the point with Pagaya is that they're an Israeli company. And so now what happens? Let's say they go to war, and then, well, you need people to go to war. So what happens? 10, 20% of your employment base? Yes, they have locations in New York and stuff like that, but you're going to take a hit to your employee base, which means that I would imagine, unless you just have a bunch of unnecessary employees, then your performance of your company and what you'll be able to do and how you service things and such takes a hit. So there's real implications to it. I mean, if you get conscripted to go to war, you're not working at Pagaya, which means that Pagaya is going to be suffering somehow. And nonetheless, Pagaya opened down call it 10% on Monday, and then by the end of the week, it's closed down roughly 20%, we'll call it. And it's at an interesting make it or break it point from a chart perspective. I didn't provide one here, so forgive me. But that's just how my brain thinks when I'm thinking about, I didn't buy any Pagaya. I've looked at it. I said Upstart because they're kind of lumped together as competitors. And there's no way in hell I'm buying Upstart. So, well, with that said, thank you for watching, and until next time.